Welcome back to Investing Talk Podcast.
Today we're looking at CoreWeave.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis, and this is a really interesting one. CoreWeave has kind of mastered this niche of AI infrastructure.
Right. They're not trying to be everything to everyone.
Exactly. They specialize purely in high-performance GPU cloud services. So if you're wondering where all these massive AI models get trained, well, this is the engine room.
And I think that focus really helps explain their identity. They didn't go head-to-head with, the huge generalists like Amazon or Google.
No, they went deep. That's the crucial starting point.
Right.
Hyperscalers are built for breadth, for reliability across every possible kind of workload.
But
CoreWeave is optimized top to bottom, for one thing. The massive parallel processing that large language models demand. It's like they're selling high-octane racing fuel, not just regular unleaded.
And that focus is just...
Yeah.
It's translating into unbelievable growth. I was looking at the numbers. For Q3 2025, they reported something like, what was it, $1.4 billion in revenue.
For the quarter.
For the quarter. That's a 134% jump year over year.
And that's not even the whole story. Management's own forecast for the full year 2025. They're projecting revenue to hit between $5.05 and $5.15 billion.
So the growth is actually accelerating.
It is. If you do the math, that's about 174% year-over-year growth. This is hyper-growth at a multi-billion-dollar scale. It's wild.
What gets me, though, and what you just don't see with these kinds of growth stories is the visibility, the certainty. They already have years of revenue completely baked in.
The word backlog barely does it justice. I mean, get this. They have a disclosed $55.6 billion contracted revenue backlog as of Q3.
55 billion. You have to pause when you see that number.
You really do. It's larger than the GDP of some countries. We need to talk about what that actually means because it gives them so much leverage.
Well, it means market confidence, right? And it's not some distant promise. About 40% of that total. So roughly $22.4 billion is expected to turn into actual revenue in just the next 24 months.
That's 2 years of basically guaranteed multi-billion-dollar growth, no matter what the market does short term.
And it's who is writing those checks that matters.
Absolutely. If this backlog was all just, shaky startups, that number wouldn't mean much. But we're seeing the absolute giants of the industry here.
OpenAI, for one. Their total contract value has now climbed to $22.4 billion.
And they're not done. They just amended their agreement with Meta, adding another $14.2 billion to that backlog.
That is a huge concentration, for sure.
Yep.
But it's with partners who, well, they absolutely need this capacity. It fuels their entire business.
It does. And while those two are the anchors, they are diversifying. They have relationships with customers you'd call investment grade. Microsoft, Mizuho Bank.
Even NASA's Jet Propulsion Laboratory.
Right. So now something like 60% of that massive backlog is secured with these really high-quality clients. That is the definition of customer stickiness.
Okay, so that connects to their competitive moat. You were saying it's structural, not just technological.
Yes, and this is a key point.
Wait, structural? I always assumed the biggest bottleneck was just getting your hands on the next NVIDIA chips. Isn't that what they're selling?
They're selling access to the chips, yes, but the deeper problem is having a place to put them. The global AI infrastructure market is facing a funding and deployment gap.
How big a gap?
Some estimates put it between $500 and $800 billion annually. Demand is just. It's completely outstripping our global ability to supply the data centers.
So this is less about a GPU shortage and more of a utility and real estate crisis.
Precisely. NVIDIA is making the hardware. The real scarcity now is the physical infrastructure. In the industry, they call them powered shells data centers with massive dedicated power and cooling.
And grid interconnection.
Getting the power utility to sign off can take literally 5 to 7 years in some places.
And somehow, CoreWeave got ahead of that. They've become a beneficiary of this scarcity because they secured the sites, the power, and the capital ahead of everyone else.
And then they layer a technological advantage on top of that structural one. They aren't just renting out space, they're selling a highly optimized, bespoke AI architecture.
This is where it gets interesting for people watching the hardware. Their infrastructure supports the new NVIDIA GB300 NVL72 systems. Why is that specific detail so important?
Because the GB300 represents the absolute next generation of AI supercomputing, the fact that CoreWeave has access to it and can deploy it so early, it signals that NVIDIA sees them as a crucial partner, not just a customer.
It kind of confirms their position as the premier high-end infrastructure layer.
Yeah, and we saw that again with the new partnership they signed with Runway, the AI video platform.
Right, one of the most GPU-hungry companies out there.
Exactly. So this capacity, this moat, it lets them command serious pricing power. And that leads to the next point. This isn't just growth at any cost. This hypergrowth is actually highly efficient.
Okay, so how efficient are we talking?
The profitability numbers are really robust, especially when you think about the fact they're in this huge build-out phase. In Q3, they hit 61% adjusted EBITDA margins.
61%.
And 16% adjusted operating margins.
So for people maybe less familiar, what does a 61% adjusted EBITDA margin really tell you about the business?
It tells you they have an immense operating leverage. Adjusted EBITDA strips out the huge non-cash costs like depreciation on all that new hardware. So hitting 61% means for every dollar of revenue, 61 cents are pure gross operational profit.
And to do that while growing revenue by 174%.
It's a rare feat. It proves their unit economics are incredibly strong.
Okay, so we've laid out a really compelling bull case. Hypergrowth, huge backlog, great margins. Now we have to pivot. We have to look at the risks because the bear case is pretty significant.
It is. This is the central tension of the whole story. They are currently unprofitable on a net income basis, and their free cash flow is, well, it's deeply negative.
Deeply negative might be an understatement. They spent, what, between 1.9 and 2.9 billion on CapEx in Q3 alone.
Right. They're spending more than they're making in revenue.
Which would sink almost any other company.
And that cash burn is what scares a lot of investors off, but you have to frame it correctly. The CapEx is strategic. It's intentional. They aren't spending to find demand. They are spending to fulfill that $55.6 billion in contracts they already have.
So it's the classic infrastructure playbook. Spend billions up front to build it, lock in the long-term contracts, and then the cash flows for years.
Exactly. It's like building a pipeline or a power grid. The upfront cost is staggering, but the future cash flow is locked in.
Okay, that makes it strategic, but what about the debt? They're holding $18.8 billion in total debt. That is a massive number.
It is a massive number, and you have to ask about concentration risk. What happens if an anchor client decides to bring compute in-house?
That's the critical question.
It is, but the key is how that debt is structured. The market knows this isn't just unsecured corporate debt. It's largely secured by those fortress-like customer contracts. It's more like infrastructure financing.
And we can see the market's confidence in their credit trajectory, right?
Absolutely. They've successfully refinanced debt at much lower costs. They secured a big tranche at SOFR plus 425 basis points. What that means is the risk premium on their debt is falling. The banks are saying, we feel safer lending you money today than we did 6 months ago.
Because they trust the cash flow from those contracts.
They do. Okay, but we also have to talk about the recent stock volatility. The stock took a huge hit. It fell, what, 32%, maybe 50% from its peak in November? If the fundamentals are this strong, why did the market react so harshly?
That's the disconnect.
That sell-off was a classic case of the market confusing execution risk with a demand problem. It was triggered by a miss on CapEx guidance and supply chain delays. Some third-party data centers weren't ready on time.
So it wasn't customers walking away. It was a timing issue with getting the powered shells online.
Exactly. The demand is still locked in. The revenue is just deferred. And once those bottlenecks ease, that revenue should really accelerate.
Which ironically created what a lot of analysts now see as an asymmetric opportunity. Let's talk valuation, because after that correction, it looks cheap for its growth.
The dislocation is really noticeable. You look at the valuation, and based on their 2025 revenue projections, it's trading at an EV to sales multiple of around 8.4x.
8.4 times sales for a company growing at 174%.
Right. I mean, put that in context. You look at other AI plays, even NVIDIA, they're trading north of 22 times forward revenue. CoreWeave looks significantly discounted.
And the chart seems to back that up.
It does. After that sell-off, you saw a classic oversold reversal. And crucially, there were huge trading volumes at the lows. That signals that while retail panicked, institutional money was quietly moving in.
Accumulating. So what are the specific catalysts on the horizon that could drive a re-rating?
There are a few. First, The move into government contracts with CoreWeave Federal. They're targeting the U.S. government and the defense industrial base. That's a huge market that values exactly what they offer.
Secure, specialized, high-end compute.
Perfect fit. Second, and maybe more immediate, is the expectation that the whole powered shell bottleneck will start to normalize by Q1 2026.
So once that constraint eases.
Once that eases, they can deploy the GPUs they already have and start converting that massive backlog into revenue even faster. That's when the market will really see the operating leverage.
So when you put it all together,
Yeah.
what's the bull case for the long-term investor here?
I think it's a compelling one. You have this rare combination of accelerating hypergrowth, incredible efficiency with those 61% EBITDA margins, and just unprecedented revenue visibility from the backlog. The market has temporarily discounted it because of a manageable timing risk.
Which is why you see analyst targets in that $140 to $150 range.
Right, once the execution stabilizes.
That brings us right back to the central tension of this whole thing, doesn't it? Their entire rise was fueled by this aggressive investment and massive debt.
A necessary evil, you could say, to secure the capacity they needed. They bet big and they bet early.
So given the extreme cash burn required to secure that capacity today, the real question for you, the long-term investor, is whether the eventual operating leverage from that massive contracted backlog will outweigh the sheer cost and financial risk of this hyperinvestment phase. It's a high-stakes bet on the future of global compute.
It's a fascinating test. If you want more analysis like this, make sure you subscribe and like the video. And if there's a company you want us to look at next, let us know in the comments. We'll see you next time.